Good day, fellow investors. Index funds are okay tools for investing, but the sad truth is that those vehicles are not going to make you rich over the next decade or 2 decades, because everything has changed with index funds, and here we're going to dig into alternatives to the S&P 500 as you requested them. I've made this video about the S&P 500, how it is a good vehicle for dollar cost averaging, thus saving and slowly accumulating wealth over time. The returns are likely to be slightly negative in the short term for real returns, likely positive nominal returns as we have inflation. Thus, you will get some wealth protection, you will be allowed to save over time, and 10 years, 15 years, 20 years, 30 years down the road, you will likely do okay. However, also keep in mind, anything can happen, and as we said in this video, all the links to the videos will be in the description below. The S&P 500 can always crash 40–30%, and that's normal. That has happened in the past many times and will happen again, so you have to accept that as a given. But stick to your strategy. And the key is that you own good businesses, as we have discussed here, businesses that grow, that have great market positions, so it's very unlikely that it will go bankrupt, but how good of an investment it is depends on the value and the valuation. I have made a valuation, you can download this table in the link in the description below, for the S&P 500, and if we look at the valuation based on dividends, yes, based on dividends, because dividends, as we will discuss tomorrow, are the key for investment returns, and if I keep the valuation now at the current 1 point something dividend yield, expect 5% dividend growth rate, 2% earnings growth rate ahead, plus 3% from buybacks, that's 5%, and then you have a correct valuation for the S&P 500. But if the dividend yield changes from, let's say, the current 1.34% to 4%, like it was the case in the past, then the present value for a 7% expected return is 1,707 points. So I don't know where interest rates will go, but keep in mind the risks of interest rates. Because like it or not, over the last 40 years, interest rates have gone from 20% down to the current still below 1 and now hiking, but still, this is still ridiculously low. This is still 14 years of zero. So when we have zero, financial assets go up. So if it reverts like it did sometimes in the past, financial assets go down. That's a given. On the other hand, you have good geographic exposure, so the S&P 500 is also globally diversified. The revenues are 40% international, which gives you, let's say, a global perspective owning good businesses. That's the key. But I don't think the S&P 500 will give you this return as it has been the case for the last 20 years, because for the last 20 years interest rates went from 6% to 0, so that really pushes stocks higher. If interest rates return to 6, then it will get uglier. Low returns for the S&P 500 likely ahead, and many of you asked for alternatives. Let's look at those alternatives. Let's start with value. So the iShares value factor ETF, the number of holdings is 330, good diversification. So the dividend yield is good, just below 3%. This is after the fund's fees. So this is the real dividend yield. So 3%. Nothing bad there. The PE ratio looks really low, but keep in mind iShares doesn't calculate losses when it calculates the PE ratio. Sustainability, for those of you who are interested, where do they invest? The fee is a little bit higher than average ETFs, but it is what it is. However, if I look at the companies here, British American Tobacco, okay, tobacco, Shell, now, so Toyota, car, cyclical, utility, so not really companies, the big Monsanto here, so not really companies that have some stellar potential when you compare it to the S&P 500, where you have companies that are still growing, still doing really great. So when you look at the quality of business, then this has an advantage compared to these companies, because banks, etc., etc., Rio Tinto might look good as a cyclical, but not really stellar businesses. Good big businesses, but mostly here because of their market capitalization, not really investing long-term quality. And plus, the higher the market capitalization is, the bigger is the weight in the index fund, thus you pay more. Let's go to the next one, the iShares value factor. So large and mid-cap stocks from emerging markets. And if we look at the chart over the last 5 years, it didn't do really stellarly. What's that? 20%. So much worse than the S&P 500. But let's see what is in the fund. So Taiwan Semiconductor, made a video about it, was expensive, now it's likely lower. Then you have these Chinese banks, this is a cyclical, doing good and bad, you have to buy it when it does bad, again cyclical. So here is Tencent, the tech, so businesses that represent, yes, those companies, but there is a lot in these businesses, especially few people understand Chinese banks and how and when to invest in those. So it's really tricky, and I expect here average long-term returns. It might be cheaper, it might be, but it's impossible to know, and therefore it's good for diversification if you want to have more diversification. So if you want more exposure to emerging markets, but even by owning the S&P 500 you are exposed to emerging markets, as 40% of the revenues are international, and all those businesses are growing also in emerging markets. Let's go to emerging markets ETF. So you can see that emerging markets have high volatility, and the fund, this was really a boom, didn't do much over the last 20 years. So one can say, yes, emerging markets are now much cheaper than the normal S&P 500 developed markets. But then again, let's see what is in this fund. You can read here on their pages what it is there. As we have seen here, we have a little bit of Reliance Industries, exposure to India, of course, but then again, China Construction Bank. So a mixed bag, and this will likely do better than the other that we have seen, but you never know, and it all depends at what price, at the sentiment, and always keep in mind that they keep the highest exposure, 20%, with the companies with the highest market capitalizations. Let's go to the Vanguard Total World Stock Index, and then you can see here just 10% emerging markets, mostly North America, and this looks like the S&P 500 with a little bit of other. So again, for wealth accumulation reasons over the long term, protection from inflation, all these things are good. Low fees, you just buy something, stick to the strategy, as we have discussed in the dollar cost averaging video. I don't know which one is better. It's impossible to know. The S&P 500 looks good for those purposes. The others, some look better, some look a little bit weaker, but I don't know where will those go. Maybe you can say, okay, I like the dividend of 3%, that's good for me, better than 1.5, and then I reinvest or do whatever I want with it. But it is about it. 3%, 1%, as I said, it won't make you rich over the long term. Another world index, so let's see what they are holding here. The fee is 0.32%, but then again, as we said, the S&P 500 with a little bit of an added global mix. If we go to Europe, and this is perhaps the ugliest of all, we'll make next week a video about Europe, and valuations are high for the quality of what the businesses that are especially working in Europe. Okay, ASML, different business, but if you look at these, let's say, big companies, big European companies, if you look at their valuations now, it's not really stellar, and it can get really ugly. So I would say that European companies, okay, Prosus not, but there is something in that's quality. But if you look at in general, Intesa Sanpaolo, the next time when there is issues in Italy, Spain, etc., this is going to get really interesting. So if you can avoid this, this is what I would say is ugly, uglier than the other options we have discussed. And I have analyzed some of these European companies in this video. Below you can check and you can see how the valuations were especially higher. Now those are a little bit lower, but still not something that I consider like, wow, buy, put all your money into that. Now, to conclude, so we have some ugly, some okay, S&P 500, global index, ETF, emerging markets should do okay. You have the dividend. If you like the 3% dividend, that's about it. So you will get protection from inflation in a way. The index funds will always go up and down, as we have seen already. 50% down is always a possibility. You have to keep that in mind. And that is investing. There is no magic about it. Interest rates went down for the last 40 years. Everything went up. Everyone feels rich. If that reverts, like they can't go lower anymore, you might get inflation protection if we have more inflation. And that's it. And that's still good. So that is protection from inflation, zero real returns, allows you to save and build wealth over time. Will not make you rich, but as Charlie Munger says, why would getting rich be easy like it has been in the last 40 years? Keep in mind, index funds started in the 70s, nobody knew about index funds, and then those got traction when interest rates went lower. And I have received this improved design for my Outlook, thank you. And if we discuss index funds, I put them here, okay, for saving over the long term, avoid Europe a little bit, but not great as it has been the case in the last 40 years. So this is it, not stellar, but okay, and that's extremely important for people to understand. Everyone wants the excitement, where should I put my money? You just have to understand the risk and reward of everything, and I hope I explained it in this video. Now, if you want better, you have to put effort in. You have to work like with everything else in life. That's life, that's investing, and with that, click that like button. Thanks, and I'll see you in the next video.